Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Navigating Margin Calls, Strategies to Protect Your Investments. Understanding margin calls. What traders need to know in 2024. Ever felt a sudden jolt while trading, like your financial world might come crashing down? That could be a margin call knocking at your door. This concept isn't just trader jargon, it's a crucial wake-up call that can impact your finances. When your account balance dips below the required margin, it's a signal to add funds or liquidate positions. But why does this happen, and how can you best prepare? This video will guide you through the fundamentals of margin calls, helping you trade smarter and more confidently. Get ready to understand this vital trading alert and protect your investments. What is a margin call? In the world of trading, understanding key concepts can make all the difference. One such concept is the margin call. It's crucial for traders to know how margin calls work and why they matter in trading activities. Let's explore this concept in more depth. Definition and explanation. A margin call is a broker's demand for an investor to deposit additional funds or securities into a margin account. This happens when the value of the securities in the account falls below a certain level known as the maintenance margin. It's like your broker giving you a heads up, saying, "Hey, your investment is shrinking, and you need to boost it up. Here's how it works." Margin account basics. Investors use margin accounts to borrow money from brokers to buy more stock than they could with their own money. It's like getting a loan to increase your buying power. Triggering a margin call. When the value of the securities bought on margin decreases, the equity in the margin account may drop below the maintenance margin. This is often set at 25% of the total value of the securities in the account, but it can vary. Investors' response. Once a margin call is triggered, the investor needs to either deposit more funds or sell some of the assets in the account to cover the shortfall. If they don't, the broker may sell the securities to bring the account back up to the required level. Think of it like a warning light on your car dashboard, urging you to refill the tank before you run out of gas. It signals that it's time to take action to maintain your trading position. Importance in trading. Margin calls play a vital role in maintaining the stability of trading positions. They serve as a safety net, ensuring traders don't end up owing more than they have. Let's break down why they're so important. Risk management. Margin calls help manage risk by keeping the investor's account value above a certain threshold. This protects both the trader and the broker from excessive losses. Discipline and control. Having to meet a margin call forces traders to stay disciplined and maintain control over their investments. It encourages careful monitoring of market movements and portfolio adjustments. Market integrity. Margin calls ensure that traders are not over-leveraged, which can destabilize financial markets. By keeping positions in check, they help maintain market integrity. Prevention of liquidation. By responding to a margin call promptly, traders can prevent forced liquidation of their securities, allowing them to retain control over their trading strategy. Understanding margin calls is like learning to balance on a tightrope. They keep traders from tipping too far into risk, helping them achieve steadiness in an ever-changing market. How margin calls work. Imagine borrowing a book from a friend, promising to return it, but if you misplace it, you must replace it immediately. That's similar to how a margin call works. When you invest using borrowed money, you promise to keep a minimum amount of your own money in the account. But what happens when things don't go as planned? Let's break it down step by step. The margin requirement. The margin requirement is like a safety net for your investments. It's the minimum amount of money or securities you must have in your account when trading on margin. Think of it as your skin in the game. How it's determined. It varies depending on the asset. For example, a 50% margin requirement means if you want to buy $10,000 worth of stock, you need at least $5,000 of your own cash or assets as collateral. Why it matters. This requirement is put in place to protect both you and your broker from excessive losses. It's like making sure you have a life jacket before jumping into deep water. Triggering a margin call. So, when does a margin call happen? It tends to appear when you least expect it, much like an unexpected pop quiz. A margin call is triggered when the value of your account falls below the broker's required minimum, and this can happen due to market volatility. Sudden drops in stock prices, much like a roller coaster dive, can catch you off guard. Losses. If the investments you purchased with borrowed money are losing value, it can quickly lead you to a margin call. Basically, it's your broker's way of saying, "We need more funds to keep this position open." Broker's role in margin calls. Your broker is like the vigilant guardian of your margin account. They watch over your investments and ensure you're playing by the rules. Monitoring. Brokers keep a close eye on your account balance compared to the margin requirement. They use advanced software to alert them if you're tipping towards danger. Enforcing. When you receive a margin call, your broker requires you to deposit more money or securities to meet the minimum requirement quickly. If you don't, they'll start selling off your assets to cover the shortfall. This oversight ensures that both you and the broker are financially secure, preventing small hiccups from sparking larger financial blazes. With all of these elements in play, understanding margin calls can feel like navigating a complex puzzle. But once you grasp the basics, it's easier to manage the risks and keep your investments secure. Types of margin calls. Understanding margin calls is crucial for anyone involved in trading. They serve as a warning and a call to action, signaling that your brokerage account is running low on equity. Unfortunately, they aren't all the same. Let's explore two key types of margin calls and what they mean for you. Maintenance margin calls. Think of maintenance margin calls as a checkpoint. When you open a margin account, you're required to deposit a certain amount of money known as the initial margin. But what happens when your account balance dips below a safe level as the market fluctuates? That's where maintenance margins come into play. Definition. A maintenance margin call occurs when the equity in your account falls below the minimum required level. Difference from initial margin requirements. Unlike the initial margin, which is the upfront amount you need to begin trading, the maintenance margin is about keeping your account in good standing. It's like needing a minimum fare on a taxi app to keep the ride going. If a maintenance margin call occurs, you must either deposit more funds or sell some of your holdings to get back on track. Failure to do so might lead to the broker closing your positions to cover the shortfall. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.